Welcome to Talk Tickers, where we're breaking down the earnings calls that are really moving the needle. And today, we are unpacking an explosive one. Byrna Technologies, that's ticker BYRN, just dropped their fiscal Q3 report for 2025. And believe me, the market took notice. I mean, the stock popped over 21% on the day of the release. So the huge question is, what on earth did management tell investors that got them so fired up? All right, let's dive in and see what's going on. It all starts with those big headline numbers. And the very first thing investors saw was a clean beat right across the board. That just immediately set a super positive tone for the whole thing. Okay, get this. Byrna posted adjusted earnings per share of 9 cents. Now, that might not sound like a lot, but it absolutely blew past what analysts were expecting. They were looking for something between 5 and 7 cents. So a solid profitability beat right out of the gate.
And that profit beat? Well, it was powered by some really strong top-line growth. Revenue hit $28.2 million. That's a 35% jump from the same quarter last year. And here's the crucial part. They're not just growing for the sake of growing. They're proving that this growth is becoming more and more profitable. So where did that 35% revenue jump come from? Well, a huge piece of the puzzle is their physical expansion. Byrna is now in over 1,000 stores across the country. I mean, that is a major milestone, and it's putting their product in front of way more customers than ever before.
In this table right here, man, it just perfectly illustrates the operating leverage they have and their model. You can see revenue up 35%, right? But look down at the bottom line. Net income and adjusted EBITDA, they both nearly doubled year over year. This is exactly what investors want to see, that scalable profitability where every new dollar of revenue is actually more profitable than the last. Okay, so that's the what happened. But the real story from the earnings call was the why. Management laid out a really clear, really compelling strategy for how they're pulling these numbers off. And it really all boiled down to 3 key things. First, that aggressive retail expansion we just talked about. Second, and this is fascinating, a new AI-driven advertising campaign. And third, the production ramp-up of their brand new compact launcher, or CL for short. So that AI-driven advertising campaign had a pretty stunning impact. On the call, the CEO talked about how it just dramatically boosted their brand awareness. I mean, look at this chart. Daily web sessions jumped from around 33,000 before the campaign to nearly 58,000 by September. That is a massive increase in people just checking them out. And you know what? They've got a very clear plan to turn all those eyeballs into dollars. The CEO pointed out that this traffic surge has grown their email list to 1.9 million subscribers. That is a huge asset, and they plan to use it for targeted promotions during the super critical holiday season. It's all about converting that interest into actual sales. Now look, no earnings report is ever perfect, and some of the sharp-eyed investors definitely noticed a little dip in gross margins. So let's talk about how management addressed this head-on. So gross margin came in at 60%, which is down from 62% a year ago. Management said, look, this is happening for 2 key reasons. First, more of their sales are coming through dealers and retail channels, and those just naturally have lower margins than selling directly to you. And second, you got the typical startup costs that come with ramping up production for a new product, in this case, the compact launcher. Both of these are seen as temporary, growth-related pressures. But, and this is the crucial point that the market really grabbed onto, despite that little bit of gross margin pressure, adjusted EBITDA still nearly doubled to $3.7 million. This shows some incredible operating leverage, and it proves the business model is scaling really efficiently. Honestly, this is why the market pretty much just shrugged off that margin dip. So how did all of this news actually translate into the stock's performance? Let's connect the dots between the report itself and the reaction we saw on Wall Street. Well, the initial reaction was just explosive. On October 9th, the stock shot up over 21% on huge volume. But then, the next day, it gave a little bit back, fading about 4.6%. This 2-day action kind of suggests the market absolutely loved the results, but is now in a show-me mode, They're waiting for Byrna to prove they can really execute during this all-important holiday quarter. Which brings us to our final segment, the next call. What should we all be watching for next quarter? And what's our take on the stock from here? Looking ahead to that Q4 report, there are 3 key things to keep your eyes on. First and foremost, holiday season sell-through. Did they convert all that web traffic? Second, we're going to be looking for margin improvement on that compact launcher as production scales up. And third, we'll want to see the early adoption numbers for their new ByrnaCare service plan, which could add a really valuable recurring revenue stream. So, what's our take here at Talk Tiggers? We are initiating coverage with an outperform reading. Our thesis is pretty simple. Management's confident growth guidance and the proven profitability leverage they have, well, that more than offsets any of these temporary margin pressures. The story right now is all about holiday execution, and we think the company is really well positioned to deliver.
And of course, just a reminder, this is not financial advice.